Hello and welcome back to the channel. In today's video, we will discuss Know Your Customer Policy and Customer Acceptance Policy. As this is the first video of Know Your Customer. As I am starting this first video, the objective of a Know Your Customer policy is to ensure that the bank or financial institution verifies the identity and background of its customers. This is done to prevent money laundering, terrorist financing, fraud, and other illegal activities. The Customer Acceptance Policy (CAP) is a key part of KYC, laying out criteria for onboarding customers while ensuring compliance with legal and regulatory requirements. Example: a bank's objective is to ensure that only legitimate customers open accounts. For instance, before allowing a customer to open a savings account, the bank asks for valid identity proof like an voter ID, passport, and address proof utility bill. This helps to establish who the person is and where they live, protecting the institution from fraud and suspicious activities. 2. Genesis of Know Your Customer. The need for Know Your Customer emerged to address money laundering and financial crime. Various regulatory bodies around the world, like FATF Financial Action Task Force, developed guidelines to ensure financial institutions are not used for criminal activities. A. Practice of introduction. In the past, the practice of opening accounts often relied on introducing a new customer through an existing customer. However, this practice was found inadequate in stopping fraudsters or criminals. Example: earlier, if Mr. O wanted to open an account, he could be introduced by Mr. B, who already had a bank account. This was a casual method to ensure trust. But it did not verify Mr. A's real identity, which was later replaced by formal KYC requirements. B. Proposition of Customer Due Diligence (CDD). Customer due diligence refers to the steps taken by financial institutions to verify their customers' identities, assess their risk levels, and monitor accounts over time. There are different levels of CDD based on risk: simplified due diligence (SDD) for low risk customers and enhanced due diligence (EDD) for high risk ones. Example: for a customer opening a regular savings account, the bank may only ask for basic ID and address proof (STD). However, for a non-resident account (NRI), where money is sent from a foreign country, the bank might carry out a more thorough background check, including income source and purpose of the account (EDD). C. Need for Know Your Customer Policy. The primary purpose of a KYC policy is to establish the identity and background of the customer to mitigate risks of fraud, money laundering, or criminal activity. Example: a real case of Know Your Customer policy preventing crime was during the OneCoin cryptocurrency scam, where many fraudulent accounts were linked to OneCoin. Financial institutions were able to track these transactions to prevent further fraud and report suspicious accounts through their KYC checks. 3. Periodical review. KYC is not a one-time process. Periodic reviews are required to update customer information, especially for high-risk accounts. Example: if a high net worth individual HNI opened an account 5 years ago, their financial profile and risk exposure might have changed. The bank would periodically review their Know Your Customer details to ensure the information is up to date and reassess the risk level. In conclusion, Know Your Customer and Customer Acceptance Policy are vital for ensuring the integrity of financial institutions and preventing criminal misuse. By applying real examples and ongoing monitoring, institutions are better equipped to manage risks. Now, coming to our next topic: Elements of KYC Policy. Know Your Customer policy is crucial for financial institutions to prevent money laundering, terrorist financing, and other illegal activities. The policy ensures that banks and financial institutions thoroughly verify the identity of customers and continuity of customers and continuously monitor their activities. Let's break down the four elements of a KYC policy with detailed explanations and real world examples. A. RBI Guidelines. The Reserve Bank of India issues comprehensive guidelines to ensure that banks and financial institutions follow consistent procedures for customer identification and due diligence. These guidelines aim to prevent illegal activities such as money laundering, verify the identity of customers, and monitor transactions to detect suspicious behavior. In 2019, Punjab National Bank (PNB) was fined rupees 1 crore by the RBI for non-compliance with KYC norms. The bank failed to adequately verify the identity of certain corporate account holders, leading to suspicious money transfers going undetected. B. Contents of the policy. The KYC policy of any bank or financial institution typically has four main elements. 1. Customer Identification Procedure CIP. This process ensures that the bank verifies the identity of all customers using valid and reliable documentation. Example: a person opening a savings account at State Bank of India (SBI) is required to submit an RI utility bill as address proof. The bank checks if the documents are legitimate and if the person exists. 2. Customer Due Diligence (CDD). Based on the customer's risk level, the bank applies either SDD or EDD. Example: a foreign businessman opening an account in HDFC Bank is categorized as high risk due to his international transactions. The bank applies EDD, verifying the source of funds and legitimacy of the business to prevent illegal activities. 3. Transaction monitoring. Banks are required to monitor the financial behavior of customers to detect suspicious transactions that do not match the customer's known profile. Example: a customer at Axis Bank who typically deposits 50,000 rupees per month suddenly deposits 10 lakh rupees. The bank system flags this unusual activity and it investigates whether the money is from a legitimate source or related to illicit activities. 4. Risk management. Banks categorize customers into low, medium, or high risk based on their background and business activities. Risk management procedures help control the risk of illegal activities. For example, in 2020, ICC Bank flagged accounts of customers from countries listed by FATF as high risk for money laundering and applied stricter due diligence. C. Compliance of KYC policy. Compliance with the KYC policy is vital to ensure that banks adhere to regulations and avoid penalties. Financial institutions have internal and external audits to ensure KYC norms are being followed. 1. Internal audit. Banks conduct internal checks to ensure that their staff is following the KYC policy and procedures at every stage of customer onboarding and monitoring. 2. External audits. Regulators like the RBI audit banks to verify if they are complying with KYC norms. Non-compliance can result in heavy penalties. 3. Penalties. If banks do not comply with KYC guidelines, they face fines and penalties from the RBI. Additionally, non-compliance could lead to reputational damage. Example: in 2021, the State Bank of India (SBI) for non-compliance with KYC guidelines. So, SBI failed to properly verify corporate accounts, leading to suspicious transactions going unreported. Process manuals. KYC process manuals are detailed guides prepared by banks for their staff. These manuals contain step-by-step instructions on implementing the KYC policy. The manual includes the following. 1. Customer onboarding. The manual outlines which documents are required for individuals and companies, how to verify the authenticity of these documents, and what steps to take during onboarding. Example: for individual accounts, the manual instructs bank staff to request voter ID and PAN cards, while for corporate accounts, the certificate of incorporation and list of authorized signatories are required. 2. Risk categorization. The process manual explains how to categorize customers based on their risk level, such as individuals from high risk countries or businesses involved in cash heavy industries. Example: a manual might instruct staff to flag accounts from FATF listed countries for addition. 3. Transaction monitoring. The manual provides instructions on monitoring and flagging suspicious transactions, along with escalation procedures if any anomalies are detected. Example: if a customer who usually maintains a 1 lakh rupees balance suddenly deposits 10 lakh rupees, the system triggers an alert and staff must follow the steps in the manual to investigate the source of the funds. 4. Reporting suspicious transactions. The manual includes procedures for reporting suspicious activity to regulatory bodies such as FIUIND. Staff are guided on how to prepare and submit STRs in case suspicious activities are detected. Example: if a bank detects high value transactions by a low hanging individual, the process manual instructs staff on how to file an STR with FIUIND. Uh, Now coming to its conclusion, the elements of KYC policy ensure that banks operate in a compliant and secure environment. RBI guidelines provide the foundation, while the policy details the specific procedures such as customer identification and due diligence. Compliance is ensured through audits, and process manuals guide the staff in implementing the policy effectively to safeguard the institution against financial crimes like money laundering and fraud. Now moving to next topic, customer acceptance policy. It outlines the criteria a financial institution must follow when onboarding a new customer. It helps mitigate risks like money laundering, fraud, and terrorist financing by setting specific guidelines for accepting customers. Let's explain each element of the CAP with real examples. A. Prohibitions. Prohibitions refer to customer categories or accounts that a bank refuses to engage with due to high risks or legal regulations. Banks must avoid accepting customers who pose potential risks related to illegal activities. Example: 1. Anonymous or fictitious accounts. Banks are prohibited from opening accounts for anonymous or fictitious individuals. For instance, an individual trying to open an account without any valid identification or under a fake name is refused. 2. Shell companies. Banks often prohibit opening accounts for shell companies with unclear ownership structures. This protects them from money laundering schemes. In 2019, India imposed restrictions on businesses involved in cryptocurrency, labeling them high risk for money laundering, effectively banning banks from offering services to them. RBI Guidelines. The Reserve Bank of India (RBI) provides strict guidelines to standardize the customer acceptance policy across financial institutions, ensuring regulatory compliance and risk mitigation. RBI guidelines for CAP include: 1. Customer identification. Banks must collect and verify official documents to authenticate the identity of the customer. 2. Risk-based approach. RBI mandates categorizing customers into different risk groups and applying varying levels of due diligence accordingly. 3. Ongoing monitoring. The bank must continuously monitor the customer's financial activities and flag any suspicious behavior. Example: according to RBI's KYC Guidelines 2016, banks like ICICI are required to collect official documents, voter ID, PAN, passport for customer identification. ICICI Bank must perform enhanced due diligence (EDD) for high-risk customers like politically exposed persons (PEPs). C. Documents information required. Banks require customers to submit specific documents and information to verify their identity, address, and business legitimacy. This varies based on whether the customer is an individual or a corporation. For individuals, first, proof of identity (POI), PAN passport; second, proof of address (POA), utility bill, rent agreement, property documents. For corporates, certificate of incorporation and memorandum of association. Second, list of authorized signatories and their identity proofs. Example: when opening an account with HDFC Bank, individuals must submit their HDFC Bank and the utility bill. If the customer is a company, HDFC requires incorporation documents and the names of authorized signatories along with their ID proofs. E. Approval authority. Approval authority in CAP defines who has the right to authorize the onboarding of customers based on their risk category. Different customer segments, low, medium, or high risk, have different approval hierarchies to ensure risk management is properly maintained. Here's how it works for different categories. First, low risk customers. These customers present a low risk of money laundering or terrorist financing. They are typically handled by branch staff or officers at a basic approval level. For instance, salaried individuals, small retail businesses, or public sector employees fall under this category. Example: a salaried employee with a stable job, such as a government worker, applies for an account at ICICI Bank. The bank branch staff can handle the account opening with minimal due diligence. Second, high risk customers. High risk customers pose a greater potential risk for illegal financial activities and thus require a multi level approval process. Senior management, compliance officers, or the risk management department must be involved before these customers are accepted. Example: at Axis Bank, a politically exposed person (PEP) applying for an account would have their case escalated to compliance officers for additional scrutiny. They would undergo enhanced monitoring and require approvals from senior management to ensure all checks are in place before onboarding. DeFi, not to be restrictive. While the customer acceptance policy focuses on maintaining security and preventing financial crimes, it must not be overly restrictive. CAP should ensure that legitimate customers, including underserved or financially excluded populations, are not denied access to banking services. First, balanced approach. A well designed cap should not unfairly exclude low income or marginalized customers from accessing banking services. For instance, small farmers, migrant workers, or rural populations might not have all formal documentation. CAP should accommodate such customers while still maintaining compliance standards. Example: a small trader in a rural area approaches CAP shoulder State Bank of India for an account. Though the customer may not have a pay-in card, the bank would allow them to open a small account using alternative documents under simplified KYC norms. Second, flexible documentation. In situations where customers may not have formal documentation like Aadhaar or PAN, CAP should allow for flexibility by accepting alternative forms of identification as per regulatory norms. This flexibility promotes financial inclusion while still adhering to basic compliance requirements. Example: Kotak Mahindra Bank may allow a low income individual to open a basic savings account using a voter ID card if this approach ensures that people without standard documents can still access basic financial services. Now, coming to conclusion. The customer acceptance policy CAP ensures that banks follow a structured and risk based process for customer onboarding. This process allows banks to manage risks effectively by scrutinizing high risk customers while also ensuring that genuine low risk customers can access banking services with ease. By being flexible and not overly restrictive, the CAP fosters financial inclusion, particularly for underserved or financially weaker segments, while maintaining compliance with regulatory requirements. The balanced approach of CAP is essential to ensure that banks do not compromise on security but also do not deny access to legitimate customers, ultimately contributing to a more inclusive and secure banking environment. So, we have completed the KYC policy and customer acceptance policy. In the next lecture, we will see its customer identification procedure and risk management. If you want to get update of this topic, then please press bell icon of this channel. Thank you so much for watching this video.